Yes, next up, we have a regulatory panel discussion moderated by Jackson Mueller, who serves as the Director of Policy and Government Relations at Securrency. His specialties include government affairs and advocacy, public policy, fintech, strategic communications, and policy analysis. Jackson is also an alum of American University. This is a coincidence, not a setup. Jackson is joined by Ann Warner, the General Counsel of Algorand, the first pure proof-of-stake blockchain platform. Also joining Jackson are Dave Treat and Julian Legoc, to whom you've already been introduced. Jackson?
Thanks, Bob. And, I think on behalf of myself and all the panelists here today, a big thank you to American University and the Global Blockchain Business Council for putting together today's event. And Julian, I know you're a double eagle. Unfortunately, I'm only a single eagle. So, I'll have to figure out exactly how to become a double eagle at some point. So. For all those tuning in, I welcome all of you to our regulatory panel discussion. We have some heavy hitters on this panel, so really looking forward to today's discussion on a topic that it seems like everyone, including my grandmother, is focused on at the moment, and that is stable coins. And before kind of diving into our discussion, recognizing we have about 35 minutes to talk about this issue, let me just set the agenda for a minute. And I realize that the audience does have an opportunity to ask questions during this panel. Given the time and the topic for this discussion, what I'll attempt to do is, if we don't have time to address a lot of the Q&A, I'll compile the questions after this panel session and send them out to the various panelists and have them try and respond to these questions in writing. Again, recognizing the time here. Also, for the purposes of this discussion, especially how massive this topic is, we're really going to focus, try and keep our focus on U.S. policy and regulatory developments at this time in particular. And really, we'll touch on three particular areas that I really think need to be examined closer in this space. And that is, one, terminology, two, the regulatory and policy scrutiny of stablecoins, again, from a U.S. perspective. And then three, considerations regarding the interplay between central bank digital currencies and stablecoins. Again, we've got a fantastic panel. Looking forward to this discussion. And with that, let me just dive right in to the first kind of agenda item on terminology in particular. And it's interesting. I've been sending emails back and forth with the panel, and one of the last emails I sent yesterday, about 5 minutes later, we had an article pop up in Cointelegraph that was titled "All Risk and No Gain: The Vague Definition of Stablecoins is Causing Problems," which I found that to be interesting and very timely. So really, to set the foundation for our discussion, for all those on this panel, what do we really mean when we say stable coins? And in particular, how should we think of and classify stable coins in comparison to other terms in this space, your CBDCs, your cryptocurrencies more generally? And I think, since this forum is focused on social impact, and we've talked a lot about financial inclusion over the last several minutes. What are the challenges that you're seeing in terms of the terminology in this space, and then what happens if we get this wrong from a financial inclusion and social impact perspective? So, Ann Wagner from Algorand, let me start with you, and then Julian and Dave, you're more than welcome to chime in.
Oh, thank you, Jackson, and also thank you, Julian, for your interesting keynote. I appreciated that. I'm Ann Warner. I'm the general counsel of Algorand, a blockchain company founded by Silvio Micali up in the Boston area, the first pure proof of stake blockchain company, as was said before. So, Jackson, you're right. There are a lot of words floating around out there. Stablecoin, CBDC, which stands for central bank digital currency, cryptocurrencies generally, native tokens, digital assets, a bunch of other things. I think the key thing for people to understand, if you don't already, is that a stable coin is a token that is pegged to an existing fiat currency. So in other words, it changes value as that currency changes value. A CBDC, a central bank digital currency, actually is the currency of that country. It can be used instead of the dollar or whatever the currency is. And both of these are forms of cryptocurrencies, but I think the word cryptocurrency has come to have a lot of negative connotations that go with it. And I think it's important for us to drill down into what these things actually make. Now, Algorand, being a blockchain company, is pretty much agnostic to which kind of asset is above it. Because what we do, we're the platform, we're the blockchain that runs these. And I often like to say that blockchain is to cryptocurrencies as the internal combustion engine is to the car. So indeed, the engine runs the car, but the engine can also run locomotives and leaf blowers and all sorts of other things. So blockchain is a platform that actually runs different types of assets, including stablecoins. So Algorand, for example, we're one of the few blockchains with support from the two largest stablecoins, USDC from Circle and USDT from Tether. And we also are actively involved with almost 20 different CBDC projects around the world. But we keep abreast of and are very care a lot about the evolving regulation in the United States for all of these things. First of all, it is evolving. I think that's the best word for it. There are no firm regulations yet. It is not clear which of the many organizations that have an interest in regulating it, the SEC, the OCC, the CFTC, which one's going to end up being the primary regulator. I think we are most focused on the SEC because we do have a native token called the Algo, which was issued out of Singapore for the reason that we are intent on complying with all existing regulatory guidance. The SEC's most recent guidance was published in April of 2019, and it's not regulation. It's called the framework, the SEC's framework, and it talks about the Howey test, which I'm sure a lot of you have heard about, and exactly what are the factors that make something a security versus a currency. But they actually haven't issued any current guidance, and there's a lot, any current regulations, and there's a lot of different discussions going about that. And I'm happy to enter into a discussion about that when the time comes, Jackson, but I wanted to hand it back to you because you asked me to cover the differences between the types of assets.
I think that's great. And Dave and Julian, you want to chime in as well?
I thought Ann did a nice job. I might add, in terms of the meaning of the different words and how we're using them. I think what's critically important to understand is how to think about the risk profile and how to understand in terms of the differences of them. I think Ann teed it up well, that obviously with a central bank digital currency being a different form factor of the actual fiat currency, it's the same value no matter the context, right? Whether a dollar is a dollar, no matter what, where you are in the world or what context it is. And that's now equally applicable as we roll out central bank digital currencies in the digital world, and that's incredibly valuable. A stablecoin construct, you're putting its value is impacted by the brand and the construct and the system of the issuing entity. And so, you see phenomenally well credentialed, high confident entities with the appropriate balance sheet behind them and the control mechanisms and audit and compliance and all of the things you'd want to see, underpinning that private issuance. And it's important to just understand that that's the risk profile there. It doesn't enjoy that same kind of universal status that a fiat currency does. And I would add that's a really important innovation frontier, right? Where you're looking to the creativity and entrepreneurial aspects of those private enterprises in the use of the stable coins, but you always have to think about the risk profile of who's issuing them. And that's why, as Julian was describing earlier, right, all of the focus and effort that the DM team's been putting into that credibility that goes behind it, is incredibly important. And there's the other end of the spectrum. There's things that have less credibility behind them, and you just have to be cognizant of that impact, that while it's pegged to a fiat currency, just caution. Yes, it may be pegged to the currency, but think about the worst possible issue that issuing company could have, and the community's brand risk response to it, and what would happen to the value of that stablecoin, even if it is pegged. And that's kind of the risk profile to watch for, and hence why I think the thoughtfulness and incredible focus that the DM team and others are putting into, they have to build that brand and credibility to make it work. And then cryptocurrencies obviously as its own category of asset, where again you're putting your faith in the system and the construct, and whether it's Bitcoin or Ethereum or the like, you're putting your faith in a different, in your belief of what both the asset and the operating system, the risk profile of both. And so I think it's just important to always think through the risk profiles of those three different types. A little bit different from Anne. I like to group them all under the umbrella term of digital currency that has three forms, right? CBDC, stablecoin, and cryptocurrency. I don't think that's wildly different than what Anne described. Just a nuance. But I think this is where in the regulatory conversations, I think they get muddled all the time. And the risk profiles of the three get mixed, and we talk past each other. And so I think you teed it up well, Jackson, that the inadequacy of our language in this whole innovation frontier is hurting us tremendously. And the more we can align on that common language, those common standards, the common way of talking about it, the better off we're all going to be. And the more clear the regulations and the guidance and and advice and constructs can all be that wrap around them.
Julian, before we talk about the regulatory and policy side of things, any reaction to what Dave and Ann had to say?
Yeah, thanks, Jackson. It's always really hard to go after Ann, that's a brilliant lawyer, and Dave, that essentially heads up all of Accenture's tech and blockchain. But the one thing I will add to it, though, is a few numbers I think is important. If you think of cryptocurrencies, there are a couple thousand cryptocurrencies out there. You talk about stable coins, you only have approximately 10% of those that would be coined, no pun intended, as a stable coin. And then you think of CBDCs, and you have less than a handful of those. And we only have maybe one or two that are kind of in circulation, but they're still in the pilot phases. So I think David said it best. Something that is a stable coin that is pegged to or backed by is very different than a central bank digital currency that is essentially a digital representation of a fiat currency. So just a little bit more context, but always tough to go after Ann and David on this subject.
Well, let me turn to the to a bigger issue within the broader topic of stablecoins, and that's on the regulation and policy side of things. And again, just specifically focusing on the U.S., because we could talk about all sorts of international developments in as it relates to stablecoin policy. But for now, just looking at the U.S. and for those who are just starting to get in the weeds on this or unclear of what's been happening in the U.S. Let me just kind of provide a little bulleted list of activities that have happened at least over the last several months. And first of all, you've had the Office of the Comptroller of the Currency issue its interpretive letter, and the Securities and Exchange Commission's Financial Innovation Hub or FinHub issued a statement on top of that. You've had obviously several publications and statements coming out of the Fed as it relates to stable coins. You had, the President's Working Group on Financial Markets recently issued a statement on stable coins back in the Trump administration. And then you've had the introduction, especially in the 116th Congress, and we expect in the 117th Congress, of several legislative bills that focus on stable coins, including the Stable Act. So, with all that in mind, why are we at this point of where, it seems like every regulatory agency in the U.S. is interested in some way, shape, or form on stable coins? U.S. lawmakers are obviously very interested. What are the, I guess, from your perspective, and from Algorand's side, and then Dave, and speaking with a number of industry folks on this, and then Julian from DM's perspective, what are the challenges and opportunities raised by the policy and regulatory developments just here in the United States as they relate to stable coins? And Dave, let me start with you, and then Julian and Ann can jump in as well.
Yeah, thanks. I to simplify it, maybe let's jump ahead to the future. And as Julian said, right, there are only a handful of CBDCs that are just getting into a production state. But the BIS just put out a report that 80% of central banks are in some stage of the journey, and I can verify that because we're working with most of those 80%. And so what I mean by jump ahead. Let's jump ahead to a future where all of the central banks have put out a CBDC, and in the context of a currency, a foundational currency to be able to support transactions. I think certainly our approach with the Digital Dollar Project and with other work around the world, the fundamental premise is that it's monetary policy neutral. It's not meant to be a policy tool. It's a policy expression. Pardon the term. And so working, I think easily envisioned working within the current construct, of how we think about today's paper money and electronic money that flows into accounts. I think the future of the stablecoin construct, where it's taking advantage of, or sorry, let me pause. What piece I didn't add? I think it also has a very tremendously limited scope. Right, the central banks have to keep it clean and simple, and in terms of taking advantage of the technology to have the programmable nature of what you can, the logic that you can program into these tokens. I think my view is that should be very limited to the AML KYC in a U.S. context, the regulatory policies and choices and scope of a central bank itself, and that's very important to keep it clean. And conversely, then if we pivot to that stablecoin future, you're talking about opening up the innovation frontier of what does adding business logic to the token unlock. Right? Does it unlock? We're working on incredibly innovative projects around benefits distribution, around in multiple different forms. And so that ability for private enterprise to recognize those business opportunities, add the business logic into it, where we might value being able to send relief to the community of hurricane victims, for which the branch was destroyed along with their, bank branches were destroyed along with their homes, but cell phone network can get thrown up, and to be able to distribute funds that then can be spent on all of the building materials, food, essentials, all the things that they need, and not things that they don't. I think that's an incredibly interesting frontier. It's just an example, right, of adding this business logic. I think in the regulatory conversations, I think it then becomes, when you envision that future and you want to, you then need to be able to traverse all the notions of the public policy choices around that business logic and how it might work, and the business flows and the ecosystems in which you're implementing it. And that's complicated. It'll be very industry specific, and the industry standards and regulatory forums will need to weigh in. Let me try to cut this shorter. It'll be a complicated but incredibly important innovation ecosystem, and it can't get hung up on the fundamental notion of what the stablecoin is itself, because I think when you have to have that mindset of thinking of it as an application of business logic for a purpose in a business flow in an industry context, in order to then create the appropriate, modernize the laws and regulations that may pertain to it. And so I think it's important that we leapfrog the conversation ahead to the end state and then back into kind of the messy Cambrian explosion of ideas and capabilities that's happening now and will lead up to it. But I've seen incredible foresight by the regulatory bodies in starting to think about the end state. Where is this really headed? What is the core essence of it? And I think that's just critically important that continue, and that we help all contribute to the language to support it.
Julian and Ann?
Yeah.
Yeah. So
Go ahead. Go ahead, Julian.
Thanks, Ed. So just Dave, I wish we were at that end state, to be honest with you, because I think 2 of the 3 concerns and the bruises and the black eyes that I've taken now over the past 18 months working with regulators and authority bodies would essentially be solved if we had one regulatory clarity and if we had CBDC. And just the 3 concerns that we've heard loud and clear around the world has been monetary policy. David, you talked a little bit about it. Consumer protection and safety and compliance. And so if you start having, CBDCs and you start having governments that essentially bring the trust of what a central bank would bring to the table, then we'd be able to circumvent having to have a reserve and manage a reserve and have a transparency and auditability of a one-to-one backing of the particular reserve. So just wanted to lay out kind of the 3 concerns. But Anne, I'm going to let you, because I know you're in the throes of regulation and you'll do a much better job than I could.
Oh, thank you, Julian. Well, and thank you, both of you, for what you just said, because I agree with you both. In order to figure out what to do for the future, which Dave is totally correct in focusing on, we also, not only we, but regulators need to have a very deep understanding of the past and where the concerns come from. So I'm going to ask everybody just for a second to jump out of the fast moving 2021 and go back to, last century, 1933, after the Depression had ended. And we had this new things called the Securities Exchange Act, which finally gave people a way of actually learning about what these companies were like who were issuing these stocks. And then that rolled out. There was a second Securities Act. And then in 1946, they had the first big case called Howey, which was about what is a security. Now, I'm not going to go into the whole history since then, but that is the era in which the thinking around this whole field was formed. And if you roll it up into 2021, into cryptocurrencies and CBDC, et cetera, the questions are still there, which is how exactly can we get controls over these things? Are they securities? Are they currencies? And what is the difference, and what controls do we need to have? Now, one thing that's invisible to a lot of people is the other area in which people to regulate this need to have deep understanding, which is the technology itself. So not all blockchains are the same, and I'm not here just to advocate to Algorand, but rather to educate that there are different kinds of blockchain. And we're at a stage where we need to understand what those differences are in order to make sure that the underpinning, the quiet background, the quiet technology underneath the whole thing is something that's going to scale, it's going to be secure, and it's also, and this is the key word from a securities law point of view, it's going to be decentralized. So there's no one out there that's truly making a decision. It's the community's making decisions. So the proof of work system, which some of you are familiar with, it's what I call the classical blockchains, the first blockchains used and still use, is one where the next block is chosen by a group of super sophisticated computers who are trying to solve a cryptographic puzzle. And these computers, some people call them miners, are so expensive that the 60% of them are owned by only 2 companies, both of which are in China. So query whether that's really decentralized. It certainly is going to not be scalable eventually because of the complexity and the necessity of the supercomputers. And whether or not it's decentralized is questionable if you've got 60% owned by certain people. Now, the pure proof of stake system, which we can come back why it's different from the designated proof of stake, but in the pure proof of stake system, all of the tokens in the world, say 1 billion, have an equal opportunity to join it, to be chosen in a committee that chooses the next block. And the system itself, the electronic system itself, chooses randomly a committee of about 1,000 people. It takes 4.5 seconds for those tokens to make a decision to validate the next block. And then that committee disbands. So it's impossible to game it. Only takes 4.5 seconds. It's a new committee every time. You don't know who it is beforehand. It's secure, again, because you can't intercede in 4.5 seconds. And it is certainly decentralized because these 1 billion tokens all over the world have equal chances. Now, that's a lot of technology to throw in there. But once you choose the right system, the right blockchain to be underpinning what we hope will become a currency as opposed to a security, you then have a prevailing myth, which came about in the area of in the Libra hearings, really, which is that if you use blockchains and cryptocurrencies, you can't regulate them. Not true. Several of the modern blockchains have systems which enable AML and KYC. Ours, for example, has something called co-chains, which is a chain that runs in parallel to the main chain. And and if you want to use the chain, you have to go into that privately held permissioned area, and which imposes AML and KYC before going back into the main chain to do the global blockchain protocol. So that's a lot to dump into one thing, but basically to go forward, we need people who deeply understand the history and also deeply understand the technology so that they're making the right decisions about how we can move forward with the right underpinning. And I wanted to if I may, just hand it back to Dave, because when we were talking yesterday, Dave, you said something I thought was really important, which is that the decisions we're making right now are like the decisions underneath the internet. Eventually, they will not be obvious, right? Eventually, we'll have a blockchain underneath here that is just the basis. But the choice of that is seminal. I just want to hand it to you for a second because you had some really interesting thoughts about that, if I may.
Yeah, no,
Dave, she's putting you on the spot, huh?
Oh, I'm getting an echo. Can you guys hear me?
Here.
Okay, sorry. Yeah, no, thanks, Ann. It's not a panel if there's not a little bit of friction. So I'll add. I think what's really important if you think about the future that we need to build, we're really talking about systemically important infrastructure. To create the confidence in systemically important infrastructure, we spend a ton of time looking at the control layer. What is that governance and control layer that is able to offer recourse when it goes wrong, that's able to respond in ideally seconds, minutes, not hours, days, weeks, or quarters, or certainly not relying upon the legal system to be able to address an issue. And then lastly, the ability to confidently, deliberately modernize. And so I'll pick on one of Ann's words, and just in fun, I really don't like the word decentralized with an ED on the end of it, because fully decentralized, nobody really wants, right? That's not, it's not something that even from the beginnings and origins of the cryptocurrency space in 2008-9, right? The first thing that the whole community realized was that you had to find the other side of the trade. And so you can't, full peer-to-peer decentralized is not, we need to find the other side of the trade. So we need to create exchanges. People started to lose their stuff. So you need to create custodians. We need to have insurance products now. And so, coming from, just what Accenture does, like we've always, we build corporate enterprise systems globally, nonstop. That's just what we do. So that with that understanding of that operational control, the rapid governance that's required, that ability to systematically, predictably modernize, you need the right governance mechanisms to operate the ecosystem.
Yeah,
and that's different.
Ann talking about
the consensus layer and the ability, of the underpinnings of it, but really thinking about the multiple policy layers and the type of choices and decisions that get to made. It's critically important that we paint a picture to regulators and the legislators and everyone that there is the auditable, controllable, governed capability to respond to, Adina Freeman was on CNBC this morning talking about the GameStop situation and the ability to, the need to be able to halt trading, right? And so that responsiveness, that recourse, that liability layer, critically important for us to be able to describe.
Yeah, let me coin a phrase for us then. I want to call it, because I kind of agree with everything you just said. I don't think it is contradicts what I think either. I want to call it technical decentralization, which has to be coupled with centralized regulatory control, right? But technical decentralization underneath is, I think, key, provided you have regulatory controls, just as you described. So let's coin that as a new term.
I think that's the perfect add to our exchange here, because it's because many in our community, hear the word, don't hear it at that technical level. They hear it at the governance and operating level, and that's not helpful.
So let's start. I mean, we talked at the beginning of this about how words are defined differently. Let's start using this word, technical decentralization, and make sure that people understand that when you do have technical decentralization, you also can and should have centralized controls.
Yeah, I love that.
So let me break in here, because we've got a couple minutes left, and it's been fascinating.
Throw something to Julian.
But let me. I know a couple of us have already touched base on the kind of the third pillar of our discussion, which is really the interplay between CBDCs and stable coins. And there's several reports. Actually, I mean, it seems like every 5 minutes there's a report on CBDCs coming out of somewhere around the globe. But several of these reports have mentioned the potential for crowding out of private sector payments efforts. And I guess in my mind, can these two forms of value coexist with each other? And as regulators and policymakers are looking not only just at the CBDC discussion, but also stable coins and regulation and so on and so forth, what do they need to be thinking about as they move deeper into these issues? So Dave, I know you touched on this a little bit. Do you have anything else to add from your end? And then Anne and Julian, please feel free to jump in.
And Julian, I think teed it up quite well in terms of what the DM team is thinking in that future. But I'll keep it short and simple, just to give more time for others. I think that interplay of the two is the important innovation frontier, right? As Julian said, right? If CBDCs existed and were in wide common use, that ability to peg a stablecoin to a CBDC and have that interplay where the stablecoin has the innovation frontier on applying the business logic and the specific the specific use cases and business flow dynamics, but that confidence to be pegged to a fiat currency, and the stability that sorry, I shouldn't use that word. Well, I mean, it's the operative word, but what that creates, I think, is the really important innovation frontier. But let me pass it to the others, because I want to give time.
Over to you, Julian. I think you're on mute.
Oh, yep. No, thank you. And so David talked about kind of 80% of the world's central banks that are exploring the merits and the risks of issuing a digital currency. And so I think it's important, and Anne did it brilliantly when she's like, let me bring you back to 1933. So I'm going to bring you back just a decade when most regulators and authority bodies, their first experience with this type of asset class, it might have been through hearing it on the news that there was a ransomware attack that was being paid in Bitcoin, and it was on the blockchain. And so they got really skittish and scared of it. But I think the need for these central banks are looking into CBDCs really because they see a need to modernize domestic payment system. Again, the telecoms 40 years ago look like payment systems today. And so I think if you remove friction and upgrade to a digital way of payments, central governments are thinking of taking a leading role in this innovation. And it also, of course, supports cross-border trade. The last thing, and I think, Anne, you'll probably pick up on this since we discussed a little bit about it, is for many emerging economies, a national digital currency, a CBDC, are primarily being considered as a means to increase financial inclusion. And we can't lose sight of that. It doesn't mean CBDCs, even if there are just a handful today, I believe we'll have at least 20 or so in the next 5 years. It's not something that's going to happen overnight, and I think the public sector is going to rely on firms like Anne's firm and on firms like Dave's firm to really have this public-private partnership, which is sorely needed in this space.
Yeah, I couldn't agree with you more.
Final thoughts.
Yeah, and I couldn't agree with you more. I think these innovations, which I see as actually kind of a tsunami approaching us, I think one of the greatest contributions that they will make to mankind is to bring the unbanked into the financial world. And I think that's a critical understanding. I also think it's important to understand that this is a tsunami. We're not going to be able to avoid having financial digital assets in our world. They already exist, and they're existing more and more. I guess, I would close with the three myths. I'm always debunking these three myths. The first myth is if you use blockchain as the engine behind financial transactions, you lose the ability to impose controls. Not true. You can. So let's accept it. The second one is all blockchains operate in the same way. Not true. Please make sure that you understand what the differences are between the blockchains so that we make the right decisions. And then the last thing is that blockchain, or the systems underneath cryptocurrencies, are the same thing as the cryptocurrencies. And you can't use blockchain without the regulatory and other problems that are inherent with cryptocurrencies. Also not true. They're separate things. They should be thought of separately. One is the system underneath. The other one is eventually the currency on top. So if we can debunk those three myths, and I think add to it the new idea of technical decentralization with centralized controls, I think we will have made a lot of progress.